Hello, welcome everyone. Welcome to Intermediate Investing. So just for a short icebreaker, we're going to start with a survey. So I'm hoping you can see the survey right now that I'm sharing. So if you go to this link right here at the top of the screen and use this code, you can join the survey. It's just talking about what topics you're most interested in. So we're just going to have sort of an icebreaker before everyone comes in. So it kind of looks like a lot of people are interested in investment strategies and how to choose stocks. And some want to know about alternative investments, while some of you guys are unsure. These are topics that we're going to talk about today. So just while we wait for some more people, I have another survey for you guys today. Again, this is the link to enter it, and this is the code that you can put so that you can input your opinion. So the second is just if you've ever purchased a cryptocurrency. So I've seen a couple more people have come in. We're just doing a survey right now as an icebreaker. So if you just go to menti.com and use this code, you can join the survey.
Wow.
Yeah, a lot of people actually have not purchased cryptocurrency. I know a lot of people have been wanting to know more about it. It's a very hot topic in terms of investing right now. Around 2% who participate in the survey are not sure what cryptocurrency is, and a big chunk has not purchased it, while about 8% have purchased cryptocurrency.
Okay.
So it's around 12:34 now, so I think we can get started. I'm going to hand it off to Deb first before we start our presentation today.
Thank you. I'm just going to share my screen. Hopefully I can share my screen. It's always, okay, I'm just going to find. Okay. There. Welcome, everyone. I'm going to share my screen, and I hope you can see it. And I'm going to introduce you to Alexandra Rodriguez, who's going to walk us through some introductory slides. Yep, you're on mute, Alex. There you go.
Yes. Okay, perfect. Thank you, Deb. Good day, everyone, and thanks for joining us for today's session. Momoi Financial Literacy Resource Center and the Mohawk College Alumni Association, in partnership with the Canadian Foundation of Economic Education and the National Bank of Canada, have created a series of Mohawk College student-facilitated financial literacy webinars titled Wealthy Wednesdays. So welcome everyone to the third webinar of the series, Intermediate Investing. Okay, So this session is delivered from my home in Hamilton, Ontario, on land very close to Mohawk College. So I'd like to take this opportunity to acknowledge that my home and the college are situated on the traditional and unceded territory of the Haudenosaunee and Anishinaabe nations within the lands protected by the Dish with One Spoon, One Spoon agreement, and is currently home to many Indigenous people from across Turtle Island. Now, I just want to share with you a little bit about us, about Mo Money. Mo Money is here to help. At Mo Money, we are committed to helping students improve their money skills. To accomplish this goal, we host events like this one, workshops for groups, and we also have individual appointments where you can meet with myself, I'm the money counselor, and talk about your specific financial situation. We have also developed some financial resources to support you in your path to develop financial literacy skills. So this is how you can connect with us. We have different ways to get involved with Mo Money. You can follow us on social media, on Instagram and Facebook. The handles are here in this slide. You can also complete the Money Matters module. This is a great resource that you can find. This is a free course, actually, that you can find on my Canvas. In this module, you can learn about budgeting, starting a business, big purchases like cars and houses, and much, much more really good information about finances and money management. Now let's see the benefits of attending our workshops. So first of all is the co-curricular record. So the CCR is a tool for students to track this experience or any program or event not formally related to your program of study. So the CCR can be used on and off campus when applying for jobs, awards, and scholarships, and to build your resume. Just like an academic transcript, the co-curricular record is verified and approved by Mohawk College staff. So the CCR is then stamped and signed by the vice presidents, students, and international and alumni to acknowledge a student's non-academic contributions to their campus and community. The CCR can be downloaded and attached to an application to draw attention to demonstrated skills and experiences. So you need to register your attendance. We will leave you the link in the chat for that registration, and you need to enter the code MoMoney4Me. The second benefit is that you have chances to win prizes. CFI has been very generous in offering a chance for participating students to be entered into a draw to win a 100 gift card for Tim Hortons. And if you attend 4 out of 5 of our Wealthy Wednesday sessions, your name will be entered into a draw to win $250 cash. Finally, if you attend 4 out of 5 of the Wealthy sessions, you will be eligible for a financial advocacy badge. Now, I'm going to pass it to Lindsay from the Mohawk College Alumni Association, who is going to share with you some important information about the association.
Hello, everyone. Thank you, everyone, for joining us. My name is Lindsay Diamond, pronouns she, her, and I work in the Alumni Relations Office as a Career Transition and Development Coordinator. The Alumni Association is your link to the Mohawk College community after you graduate. You can connect with alumni on all of our major social media platforms, as you can see on the screen there. So I encourage all students and graduates to start following us. As a student or a graduate of Mohawk College, you are welcome to participate in all of our events. We host a wide range of events, such as social events like trivia nights or tea tasting, career development workshops and webinars, personal development webinars, and many more events. For the students in the audience today, I just want to highlight that we currently have launched our virtual grad send-off website. I'll put that link in the chat for you after, where there's lots of contests and events and stuff that you can partake as you're finishing off your final semester and getting ready to graduate. And for all our grads that are in the audience today, just a reminder to download our Perks app, where we highlight all of our events, special offers and stuff that are exclusive for our Mohawk alumni. I look forward to learning aside everyone this afternoon. So on with our feature presentation, I would like to pass it on to Patricia San Juan, our student facilitator and CFE staff for intermediate investment webinars. Enjoy.
Hello guys, good noon. So like Lindsay said, today is about intermediate investing. I'm just going to share my screen to put the slides up. Okay, can everyone see it okay? If I could just get a, if I could just get a react from you guys. All right, so let's get started. First of all, I want to welcome you guys to today's workshop. Again, my name is Patricia San Juan, and we're going to talk about intermediate investing. The Canadian Foundation for Economic Education is pleased to partner with the National Bank of Canada to provide a series of workshops to help post-secondary school students like myself and you across the country to get a better handle on their money. Today, we're going to go over investments at the intermediate level. In the basics of investing, we covered why to invest, the magic of compound interest, the different types of investments, and the different type of investment accounts. Today's session will walk you through various risk mitigation strategies, what's involved in picking stocks, and some alternative investments. So this workshop will last about an hour, and then we'll have a live Q&A at the end of the presentation. We sent a pre-survey that we hope you completed, and there will be a pro survey sent at the end of the session. If you fill out both, you will be entered into a draw for one of two $100 Tim Horton gift cards. So don't worry, we won't use your email address for any other reason except this draw. So first, a little about this program. CFE and the National Bank have partnered to offer post-secondary students across the country access to financial literacy workshops. The program, Help Managing Your Money on Campus, is designed to help support young people by providing you with comprehensive financial education modules. This is so important and timely because more than ever, we live in a complex financial world. The majority of you have likely already experienced this world of financial costs, responsibilities, planning, spending, credit cards, and much more. And that's exactly why we're partnered with universities and colleges across the country to help equip students with the information you need to take on all of life's financial challenges. We ask students what their priorities are in the first half of 2020 and what they want to learn more about. 1,500 surveys later from students all across the country, and this is what we found out. Hopefully, most have done basics where we introduce why to invest, like the magic of compound interest or growth, the types of investments and accounts, and how to get advice, as this module will go deeper on investment strategies. So here are the 3 priorities that we found out after the survey. Around 76% of students listed investing money for the future when asked specifically what topics they want more information on. And about 64% of respondents want to learn how to deal with financial stress. And 55% want to build a financially healthy life. We hear your questions and we understand your challenges. That's why we put together today's presentation. Investing in stocks, bonds, cryptocurrency, and real estate is a great way to expand your financial skills and include additional streams of income. But there is information, terms specifically, one needs to be aware of before investing your hard-earned money. And that is our primary goal with this webinar, to educate everyone with the information you need to make your own choices about your investments. So if you look on the screen, there is a bunch of investing jargon. To start off, it's worth mentioning that in the world of investing, there is a lot of jargon like what is on the screen right now. But it's really common for any subject. Like in the medical field, they have jargon like acute and negative, and the business world have things that they talk about like bang for the buck and due diligence. So there are also examples of political jargon like deep state and bipartisan. I mentioned these terms because perhaps you are more familiar with these than you are with investing language that I've put up on the screen right now. But either way, it speaks to the fact that every subject area has terminology. So today we are going to go over several basic and intermediate terms and teach you their meaning so that you can start speaking the language of investing. So first of all, we are going to do a poll to check how familiar you guys are with these terms. And if you just can follow that right now. I actually, if you were to ask me about a year ago how familiar I am with these terms, I probably would say I don't know anything that you're talking about. I actually only have recently been interested in financial literacy. So it's really a good step to intentionally make choices to educate yourself with these. Okay, so here are the results. About 63% of you guys know some of the lingo, 25% know most of them, and no one actually does not know. Like there's actually no one from the group that has no idea about these words. So you guys are all much better than me before I actually started making choices to educate myself on finances. So, okay, continuing on. What are we going to talk about today? These are the three things that we are going to talk about. Firstly, we will take a look at the investment strategies that you can use to reduce risk. Next, we will look at the techniques and strategies used to choose stocks. And finally, we will cover the alternative investment options and the benefits or risks associated with them. So let's get into it. So here are your learning objectives that we hope you guys have coming out of this workshop. So first, you'll be able to you'll be much more comfortable managing your investment risks by applying techniques like dollar cost averaging and diversification to your portfolio. You also will be able to analyze and understand the potential long-term value of a common stock of a company that you choose to invest in and the important metrics to follow. And lastly, you also will know about some alternative investment opportunities to try to diversify and enhance your risk-adjusted returns. So for the first section, investment strategies, we will cover some investment strategies that you can use to reduce your risk. So today we will be reviewing the following strategies. First is diversification. We will watch a quick video to solidify the information that we covered today on diversification. Second is asset allocation. It's a natural extension of diversification and something to keep in mind as asset allocation has been proven to drive 80 to 90+% of a portfolio's returns over time. 80 to 90+%. I don't know about you, but that's a pretty high number. And lastly, dollar cost averaging. It's a simple strategy to make a regular investment of a fixed amount in an asset. So to start us off, we are going to watch a quick video about diversification.
When you invest in a stock, you're taking a risk that the value may go down rather than up. Okay, we get it. Investing can be risky. One way to manage that risk is to learn about asset allocation and diversification. Asset allocation is financial lingo for how you distribute your money across types of investments, like the strategic decision of which baskets to put your eggs in and how many. The different baskets are called asset classes. To help you decide where to put your eggs, ask yourself, how much time do you have before you need to use your money? How comfortable are you with risk? And how does your current financial situation look? Diversification is about strategically putting the right mix of different eggs in each of your baskets. The key is that you shouldn't invest all your money in one company, one industry, one country, one anything. Ideally, you want your investments to be negatively correlated, so when one is going down, another is going up. Here are some typical ways to diversify your portfolio. Invest in companies in different countries. Own stock in small and large companies, and invest in companies in a variety of industries. One downside to diversification is if one of your investments does very well, you won't make as much as if it was your only investment. Conversely, if you owned only one stock and the company went out of business, you would lose more money than if you had diversified your money. Diversification won't eliminate risk, but it's a smart way to manage risk while allowing you to build your portfolio.
Okay, so the main takeaway from this video is to remember to not put all your eggs into one basket, meaning do not put all your money into one investment. By diversifying your investments, you're expanding your investment portfolio. You also are not reliant on just one or two investments. For example, say one of your stock investments is down for a few weeks or more, it protects you from that. So by diversifying your portfolio, you will reduce the risk of a loss from your investments. A common way like to mitigate and reduce your risk, I said, is diversification. And it can be achieved in a variety of ways. In a nutshell, diversification means not putting all your eggs in one basket, like I've said, and it's been mentioned in the video as well. You will want to have a good mix of different kinds of investments. Why? Because it provides you with some protection. If some of your investments fall in value, others may rise. If some are quite volatile, others may be pretty stable. By diversifying your portfolio, you lower your risk. You won't eliminate it per se, but you can reduce it a significant amount. So one of the primary rules of investing, is to diversify, just like how for real estate, it's all about location. In investing, it's all about diversifying. Like mutual funds and ETFs, they provide instant diversification just from their structure. ETFs, as their name suggests, exchange traded funds, trade on exchanges, just as common stocks do. Mutual funds are when you put money into a mutual fund, the transaction is with the company that manages it, either directly or through a brokerage firm. The purchase of a mutual fund is executed at the net asset value of the fund based on its price when the market closes that day or the next, if you place your order after the close of the markets. Both mutual funds and ETFs hold portfolios of stocks and or bonds, and occasionally something more exotic, such as precious metals or commodities. If you guys want more information on the difference between ETFs and mutual funds, you can check it out on investopedia.com. They do a very informative blog about the key differences between the two. So during the investment basics webinar, the different assets we covered were cash, fixed income equities, mutual funds, and ETFs. These can be great tools used to diversify your portfolio. We also mentioned the different levels of diversification. Whether you invest today or in the future, you can diversify in a number of different types of ways, like the type of investments you make, like stocks or bonds. You can also diversify in terms of the location of your investment, like Canada, US, and Asia, which can protect you for certain political situations that may affect, the stock market a lot. There are also a number of diversification strategies. You can also diversify in depending on the level of the risk of your investments. If you're a more aggressive investor who wants to take a lot more risks, or if you're a bit more conservative. There are also a number of diversification strategies that you can adopt that we will talk about. So we will look at asset allocation first, and then dollar cost averaging. Okay, so first, dollar cost averaging. Oh, sorry, asset allocation. I'm sorry. So we'll talk about asset allocation first. So asset allocation, it looks to build an investment portfolio with set proportions of different assets based on an individual's goals. So for a long-term investor, the asset allocation decision will be a key determinant of the return of the portfolio over time. Each investor's goals are in part a product of their age, risk tolerance, and investment horizon. Remember the 3 asset types we discussed in a previous workshop: equities, fixed income, and cash equivalents. Asset allocation seeks to build a portfolio made up of set percentage amounts of the various asset types. Like if you can see here below, for example, a more aggressive investor can opt to build a portfolio of 80% stocks and 20% bonds, whereas a more conservative investor might opt for a portfolio of 40% stocks and 60% bonds. From a paper by Roger G. Ibbotson on the true impact of asset allocation on returns, to summarize it, he said that the impact of asset allocation on returns depends on an individual's investing style. So for the long-term passive investor, the asset allocation decision is by far the most important. But for the short-term investor who trades more frequently, invests in individual securities, and practices market timing, asset allocation has less of an impact on returns. The impact of asset allocation on performance is directly correlated with investment style. Either way, at the end of each year with asset allocation, your assets will be bought and sold to rebalance the portfolio to your risk tolerance and to ensure a constant portfolio asset allocation, hence the name. With the stock market, like your portfolio, which you want to be 80% stocks and 20% bonds, might change to, let's say, 60% stocks and 40% bonds, but it will reassess itself and buy and sell more stocks and bonds, whatever your portfolio is, have to rebalance it again and go back to the 80% stocks and 20% bonds that you want. Okay, so this slide just shows the various asset classes and their relative positions each year. So you can see, like here at the bottom is the worst performing asset yearly. You could see that one every year, actually, like the colors are different. So you can see that every year changes which assets are doing better or doing worse. For example, if you look at the yellow squares, which is for Canadian bonds, in 2000, they are the best performing asset, but fast forward to 6 years after 2006, they've gone from best to worst. And then 2 years after that, 2008, they rise again, they go back down again. And then if you look at another example here, we'll look at US equities, the dark blue. In 2000, they're sort of in the middle, kind of worst here. But fast forward to 2015, they've become one of the best performing assets, So the key takeaway here is that different asset classes perform differently at different times. Therefore, if you have a mix, you'll ensure good overall returns with less risk. Okay, now on to dollar cost averaging. Dollar cost averaging, another powerful diversification strategy, involves regular investment of a fixed amount in an asset. Take any stock as an example. Rather than trying to time the market, which has been shown to be quite ineffective, dollar cost averaging suggests that you ignore the price fluctuations of your investment and just continue with regular and constant purchases. That means that you buy stocks through the good times and the bad. this risk reduction strategy is particularly applicable in the long run or over a long period of time. So by buying more at lower prices and buying less at higher prices, which will eventually average out your cost. Excuse me. That is because by continually buying a stock over time, not only do you keep increasing your portfolio, don't forget about compound interest, you're also able to maintain an average purchasing price that is fairly close to the market price, meaning that your portfolio's value should be more stable and less volatile. An example would be to say you're going to put $100 a month into a stock index over the course of 5 years. At times the stock index price might be $10 per share, which means for that $100, you will be buying 10 shares at those times. And then at different times, the stock index may be priced at $5 a share. So you would put your normal $100 into that stock and get 20 shares. Over time, you're averaging out the prices of the stock by buying a set amount each month. Here, for another example, we're going to look at dollar cost averaging using the S&P 500. So what would happen if you continuously put money into the S&P 500 on a monthly basis over the course of 5 years? In this example, all the investments that you made would end up profitable either way. In particular, the investments you made during the dips right here with the purple arrows, they would be doing really well because you'd get way more shares for the same amount that you put in. Let's keep in mind also that this chart accounts for stock market activity during the pandemic. So even with the pandemic occurring, all your investments are still profitable in this scenario. Okay, we've finished the first section now, and here are the key takeaways. Diversify your portfolio to minimize risks. Some of the ways that you can diversify your portfolio that we've mentioned is the types of investments, the location of investments, and risk tolerance. And also your asset allocation depends on your goals, age, and risk tolerance. Consider buying different types of assets from different countries and different sectors. And lastly, dollar cost averaging is a great strategy for the long run. The very last thing for this section before we go on to the next is that diversification is an important factor when investing, because putting all your money into one stock is like buying a lottery ticket. It's a hit or miss. You should not make it into an investing strategy. Okay, now how to choose stocks, deciding which stocks to buy. So deciding which stocks to purchase can be a complicated and tedious process. So let's go over some of the steps you should take when deciding which stocks to buy. In this section, we will be covering where can you purchase stocks from, what to look at when purchasing a stock, and what to consider when investing in the stock market. So where can you go to purchase stocks? Well, firstly, stocks must be purchased through a licensed broker. One, you can buy stocks through a full service dealer. National Bank has one, as well as all the other banks, but there are also independents as well, like Raymond James and Edward Jones. You may also sign up with a direct brokerage to purchase stocks. For example, National Bank Direct Brokerage, Wealthsimple, and Quest Trade. And you can also buy stocks from a robo-advisor, which is a blend of advice and no advice, where a broker will tailor a portfolio for you, usually of ETFs based on your risk profile. Fees for robo-advisor tend to be in between buying stocks directly and a full-service dealer. Keep in mind that every brokerage and licensed dealer has different fee structures and benefits. For instance, full-service brokerages offer professional investing advice, but this may come at a higher cost than alternative options. So make sure you do your research in order to find out which option works best for you. So what are some factors to consider when buying stocks? Here are four: the company size, industry sectors, geography, and beliefs. So first, we're going to talk about company size. Company size is a factor when deciding which stock to purchase. Market capitalization, or market cap, shows a company's value based on the stock market. The market cap can be calculated with the following formula up on the screen right now: value of stock times outstanding shares. This example of Coca-Cola is actually from June of 2021, where the price of a Coca-Cola stock is at the value of stock is at $55.65, with outstanding shares of 4.3 billion, amounting to a market cap of $258 billion. But as of last night, their Coca-Cola's market cap is up at $262 billion, with a value of stock at $60. And also, based on a company's market cap size, they can be categorized into one of the following cap sizes up on the screen: micro cap for $50 million to $300 million, small cap for $300 million to $2 billion, mid cap for $2 billion to $10 billion, and large cap at $10 billion. Now, to quickly test your knowledge, I'm going to ask you guys a question. Air Canada has a market cap as of last night of about $8.7 billion. So which category would this market cap fall under? Now, if you guys would just want to put it on the chat. Yeah, exactly. It's mid cap because it's in between $2 billion and $10 billion. Thank you. So an extra tip is, if you wanted to diversify in this scenario, you'd want your portfolio to consist of different sized companies. Some that are micro caps, some that are large, small, and mid. That's another way to diversify your portfolio. Okay, now we're going to look at industry sectors. They also play an important role in deciding which stocks to purchase. Each company listed on the stock market falls within a certain industry sector. In some instances, the sector a stock is in can have varying effects on the performance of the stock itself. Like, let's say during the pandemic, like companies like Air Canada, travel, and airlines, they're not doing as well. Listed up on the screen here are some of the well-known industry sectors: materials, financials, healthcare, energy, and information technology. So let's look at just how a stock can be affected by its industry sector as well. For instance, political pressure on non-clean energy can have significant impacts on the stock performance of oil and gas companies within the energy sector as well. And now geography also plays a role in deciding which stocks to pick. Based on a company's location, they are subject to different opportunities and risks. This is often based on the location's economic, social, and political situations. A company located in a region experiencing heavy political turmoil is most likely not the safest investment. Think with the Russian and Ukrainian war at the moment, people who purchase stocks in those markets, they're not doing so well at this moment. Economic, political, and social situations are always changing in different regions. So it's very important to stay up to date. And lastly, another important but often overlooked factor is your own beliefs and products that you actually purchase. This is when you choose to invest in a company that you use and or strongly believe in. Your personal connection with the company gives you a better perspective of the value of the company provides to its consumers. If the financials and other variables make sense, this may be a viable option when deciding which stock to purchase. So now we're going to look at growth stocks and value stock. So what's the difference between the two? Growth stocks are companies that are believed to outperform the market over time because of their perceived future potential. Growth stocks may have fundamentally expansive projects, be a leader in a new industry, and aggressive forecasting of the future, and etc. Examples of growth stocks would be Amazon, or Tesla. And then we also have value stock, wherein companies that are trading below their real value. As a result, these stocks both can be a great value if the reason for the stock being cheap is not related to the fundamentals of the business. Value stocks can actually provide a greater return than the market average over time. So this is like, let's say Tesla right now is a growth stock, but it's not forever a growth stock because it's not necessarily categorizing a stock as the growth or value stock is not necessarily they're always going to be a growth stock or a value stock. It really depends on the time right now and what is going on with the market. Okay, so before we finish off this section, let's take a look at a few of the more complicated strategies used to decide which stock to purchase. Firstly, the price to earnings ratio, PE ratio, can be potentially used to determine if a company's stock price is undervalued or overvalued. Keep in mind that this isn't a definitive calculation in terms of telling you to buy a stock or not. Low or high PE ratios aren't inherently good or bad. The PE ratio can be calculated, though, by dividing a company's current share price by its earnings per share. For example, Apple has a current annual earnings of $6 per share and a stock price of $168, and so the PE ratio of Apple is 28 times. A lower PE ratio just might mean that the company is undervalued, or investors may be losing confidence in the company, and a higher PE ratio might mean that the company is overvalued, or investors may be expecting large growth in the future. It is very important to look at PE ratios within an industry sector, as different industries will trade at different PE ratios due to differences in inherent profitability, profit margins, growth versus value, and etc. Now, the debt equity ratio, DE ratio, is used to determine a company's financial leverage. To put it simply, this calculation checks to see if a company is using their own money or debt to fund their operations, and to what degree. The DE ratio is calculated by dividing a company's total liabilities by its shareholders' equity. So a lower DE ratio means that company is operating with their own funds rather than incurring debt to fund their operations, while a higher DE ratio means that a company is incurring debt to finance their operations. It could potentially be a higher risk investment, which can pay off well if the company can invest the debt profitably. But excess leverage may also be a death knell for a company if they can't make the payments on their outstanding debt. So here's, I'm going to play a quick video for you guys to provide a deeper explanation on DE ratio. Okay.
The
Oh, I'm so sorry. I didn't realize that I actually did not screen share for that. I'm so sorry, guys. Let me just pull that up one more time. Okay. I'm so sorry. I thought it was screen sharing, but I hope the audio worked properly so that you guys, sorry, there's, okay, I just saw now that Deb said that no sound is coming through. Sorry, so I'm gonna put that video up again one more time. Sorry about the technical difficulties, guys. I didn't realize that I was watching the video by myself. Sorry, here you go. Is it working now?
Yep, I can see and hear it.
Thank you. Sorry about that, guys.
The debt-to-equity ratio is a measure of a company's financial leverage. Al and Ed both go to the bank for business loans. The loan officer looks at their respective balance sheets. Ed has $120,000 in assets, cash, equipment, and so on. Ed also has $100,000 in liabilities, mostly loans. So Ed's equity is $20,000. The loan officer divides Ed's liabilities by his equity to come up with a ratio of 5. This means Ed has $5 of debt for every $1 of equity. Ed is highly leveraged, so he's a high risk for the bank. His application is declined. Al's balance sheet is much stronger. Al has $150,000 in assets and only $50,000 in liabilities. His equity is $100,000. Al's debt-to-equity ratio is 0.5, $50,000 over $100,000. This means Al has 50 cents of debt for every dollar of equity. Al's low debt-to-equity ratio makes him a low risk for the bank. His application is approved. The debt-to-equity ratio identifies companies that are highly leveraged and therefore higher risk. But no single ratio can tell the whole story.
All right, sorry about that technical difficulty, guys. I'm just pulling up my slides one more time. So, like on the video, companies taking on a lot of debt may not perform as well as a company that has less. This is an indicator of risk. Apple is a good example. In the beginning, there was a lot of risk with the company. So by taking on debt, they would not be able to service the debt. But now Apple is making much more money, so they can afford the debt. This will increase the broad return for shareholders. So as you can see, there is a lot that goes into picking a stock. In fact, there are plenty of more complex strategies used to determine which stocks to pick, which we won't cover in this workshop. Professionals who do this full-time are known as portfolio managers. They usually have their chartered financial analyst designation, which is a series of 3 exams that will likely take one about 3+ years to complete. You can look at the CFA Institute website for that. I actually will, let me just try to put that into the chat now if anyone is interested. Yep, there's the link there. So if you want to become a stock picker, we strongly recommend starting with the Canadian Securities course. It's a single exam that you can likely complete in a few months, and I will be posting the link for that on the chat now as well. All right. So again, we're going to do a Zoom poll before we move on to the next section. So which of these is not a factor of deciding which stock to buy? Industry sector, friend recommended to purchase, the company size, or the geography? You guys can just submit. I'll just give it a couple more seconds so you guys could put your submissions in. Oh, here we go. So the results are, it's actually, the correct answer is to the friend recommended to purchase. You know, that is not a factor in deciding which stock to buy. Don't base your investments on what your friend tells you. Do your own research. You know, they have different goals, different risk tolerance, and different needs. So you have to do your own research. So the key takeaways for this section is that to understand the fees associated with purchasing and selling stocks, and that there's a lot that goes into choosing a stock, and to develop your judgment, you can also reach out to professionals in doing so. Okay, by now you would have heard about investing regarding stocks, mutual funds, ETFs, but what are other alternative investments? Let's take a look. So before we get into this section, we want to stress that these investments can get a bit complicated. Research is essential before diving into any of these sectors. With saying that, alternate investments can include higher risk. Educating yourself is essential when investing in any of the topics today, which are cryptocurrency, precious metals, and real estate as an investment. So cryptocurrency, what is it? How does it make you money? What are the risks and how do you buy it? Before we get started, let's watch a quick video again to get a better grasp of what cryptocurrency is. Okay.
Today, cryptocurrencies have become a global phenomenon known by most people, but understood by few. In 2018, you'll have a hard time finding a major bank, accounting firm, software company, or government that hasn't researched cryptocurrencies or started a blockchain project. Beyond the noise and the press releases, many people often fail to understand the basic concepts. So let's walk through the whole story. What are cryptocurrencies? Satoshi invented Bitcoin in 2008 as a peer-to-peer electronic cash system. To realize digital cash, you need a payment network with accounts, balances, and transactions. That's easy to understand. One major problem every payment network has to solve is to prevent double spending. That is, to prevent one entity from spending the same amount twice. Usually, this is done by a central server who keeps records of all the balances. In a decentralized network, you don't have this server, so you need every single entity of the network to do this job. Every peer in the network needs to have a full list with all the transactions to check if future transactions are valid, or an attempt to double spend. But how can these entities keep a consensus about these records? If the peers on the network disagree about one single minor balance, everything breaks. They need absolute consensus. Nobody knew how to achieve this until Satoshi proved it was possible. Cryptocurrencies are a key part of the solution. To illustrate this, we'll look at the transactions on the network. A transaction is a file that says, Bob gives X Bitcoin to Alice and is signed digitally by Bob. Once signed, the transaction is broadcasted to the network, sent from one peer to every other peer. This is standard P2P technology. Nothing special happening here. After a specific amount of time, the transaction gets confirmed. Only miners can confirm transactions. This is their job in a cryptocurrency network. They take transactions, stamp them as legitimate, and spread them in the network. After a transaction is confirmed by a miner, every node has to add it to its database. It has to become part of the blockchain. For this job, the miners are rewarded with cryptocurrency, for example, bitcoins. Anybody can be a miner. They just need to use some of their computer's power to qualify for the task. Every miner competes to solve a cryptographic puzzle. After finding a solution, a miner can confirm the transaction and add it to the blockchain. As an incentive to do this, they then receive a payment from the network in the form of a cryptocurrency. In this way, a network of independent actors are economically incentivized to maintain the legitimacy of the transaction history. So that's the gist of it. Cryptocurrencies are the key to the complex digital cash problem that Satoshi solved: how to maintain integrity and consensus across independent and potentially malicious actors. Cryptocurrencies are essentially the monetary incentive offered to anyone willing to keep the network secure.
Okay. Now back to the slides. So cryptocurrency is a digital asset or currency which is exchanged entirely online. Many cryptocurrencies are decentralized, direct and secure peer-to-peer crypto transactions without the need for an intermediary or middleman. It uses strong encryption to verify transactions and mitigate fraud. So I'm just gonna just coming off of the video. What is Bitcoin? It is a cryptocurrency that lives on the internet. Bitcoin first went live on January 3rd, 2009. It has since gained traction in an unprecedented way. It does not rely on a central authority, which decreases the risk of failure and corruption. Transactions are all recorded on a public ledger, constituting a blockchain. It was created by Satoshi Nakamoto. So how does it make you money? The value of cryptocurrency is based on several factors, which are mainly the following, but not solely limited to these. Daily trading patterns. High volume traders dominate the small market, which results in volatile price fluctuations on a day-to-day basis. Belief in a future use. As mentioned, crypto is relatively new and has not yet been proven. Some view a future where cryptocurrency is the default form of currency across the world. And lastly, uncertainty in fiat currency and current economy. As the pandemic has showed us, many feel uncertain about the value of fiat, like example, are dollars traded by governments, fiat currency, which has resulted in a surge of crypto buyers. So what are the risks? It's a relatively new technology which hasn't been proven at scale. A majority of cryptocurrencies won't be around in the long term, while some might. Remember, this is an unproven space. We don't know which cryptos will leave their mark and which ones won't. It is also very volatile. Since the crypto market is relatively small and is dominated by large traders, the day-to-day value of any particular coin is heavily influenced by trading patterns rather than the actual value of the coin. Remember our friend Diversification, and put a small amount of your portfolio into cryptocurrency. So there are three how do you buy it? There are three main ways to get your hands on some crypto. First is crypto exchanges. This is the most efficient way to buy crypto. They have the lowest fees in the industry. However, that comes at a cost of speed, as you need to create an account and get verified and then do a bank transfer. So be wary of fees. Many traders and exchange sites tend to charge a fee to purchase their cryptocurrencies. Some options are FTX, Coinbase, Binance, which was actually pulled out of Ontario in summer of 2021 due to OSC requirements. So be careful. There's also Kraken and Bitfinex. Another option is fintech companies. Certain existing companies now offer users the ability to sell crypto on their platforms, though their fees are higher than crypto exchanges. What you buy cannot be transferred elsewhere to an external wallet. Some options are PayPal and your wallet. Another is with a card. Some platforms offer users the ability to buy crypto with a card. These are often sought after because of the speed, but they come at a hefty cost, which with a 3% fee. Some options are Coin Corner, Crypto.com, Bitpanda, and CoinMama. So you can also get cryptocurrency within an ETF. Okay, and then now the next alternative investing option is precious metals. Okay. Precious metals such as gold, silver, and platinum are all recognized as valuable metals. It attracts because of their security and tangibility. It is a physical asset, so it does have a limited supply. Mining will continue to slow until our precious metal reserves are depleted. And it also can't be inflated, meaning it can't print more of it, unlike money. There's also instant liquidity. Most metals can instantaneously be sold back on the market for cash. So each precious metal has its own risk and opportunities. First example would be gold. It doesn't rust or corrode. It is mainly used as jewelry and also a form of currency. An example two is silver. It is also known for its intrinsic value, but is more commonly being used as an industrial metal, so it is more volatile. Over time, the value of these physical assets will go up or down based on the market. Some precious metals are known to be more volatile than others. So how does it make you money? Systemic financial concerns. What banks and money are perceived as unstable. So many prefer to invest in precious metals because they are physical assets. Because of war or political crises, many rush to hoard precious metals in this scenario as it's considered to be safe store value. And it also has a hedge against inflation. When fiat currency is experiencing heavy inflation, many opt to invest in precious metals as they hold or increase in value. This is because you can't print more of it, which means its value can't be inflated, unlike fiat currency. So the risks. Precious metal markets experience a fair level of volatility due to hoarders. When hoarders are offloading their precious metals, prices tend to fall because of the imbalance between sellers and buyers on the market. If a metal can be used like silver and solar panels, that can drive up demand and prices. However, if a cheaper alternative metal can be used, then that might hurt the value proposition of something like silver. So how do you buy it? Precious metals can be purchased from reputable websites such as APMEX or your bank. Prices will be determined by the market value, based on the weight of the precious metal you're purchasing. You will need to decide where to store your precious metals if you buy it, because it's a physical asset. You can keep it in the bank with a fee associated, or self-storage, which poses a high risk. You can also purchase ETFs and mutual funds, which are focused on precious metals. It is a great way to quickly diversify your precious metals portfolio and not have to worry about storage costs or risks. Next, let's cover real estate as an alternative investment option. So there are two traditional purposes for buying real estate. First, a buying and selling principal residence. A principal residence is the primary location where someone lives. If the property was solely your principal residence for every year you owned it, you do not have to pay tax on any gain in value when you sell. The risk with this investment is if there was a recession. This could mean your job is at risk, therefore an issue with mortgage payments. A prime example right now is how the COVID-19 lockdown is was affecting people's income. You may overpay for your home if the real estate is in a bubble, like the oversell of house at the moment. This means that you'll be purchasing at prices that may be inflated due to the high demand and low supply. Another is investment properties. An investment property is real estate property purchased with the intention of earning a return on the investment, either through rental income or the future resale of the property, or both. The property may be held by an individual investor, a group of investors, or a corporation. The goal when people invest in properties is usually to make money, and there are three different ways of doing just that. So plan a way to have 1, positive cash flow, 2, capital growth, and 3, tax advantages. Some of the risks when it comes to investment properties is it's not as liquid as other investments. This market is not predictable. Some months or years you can have a steady income, others you might not. This is due to tenants leaving or unforeseeable issues like something breaks at the property. CFE actually has an entire module on buying and selling a home. So we're going to mostly cover off an alternative way to invest in real estate in this module, which is real estate investment trust, or REITs, or as I like to call them, REITs. So what is it? The acronym REIT stands for Real Estate Investment Trust. This investment is managed by a company that owns, operates, or finances income-producing real estate. This can include commercial real estate, ranging from office buildings, apartment buildings, to warehouses, hospitals, shopping centers, hotels, and commercial forests, as well as residential real estate. REITs provide all investors the chance to own valuable real estate because you participate in the market value change of the underlying real estate. It allows you to access dividend-based income and help communities grow, thrive, and revitalize. But how does it actually work? So the REIT collects rental income, pays its expenses, and then distributes almost all its remaining income, at least 90%, to unit holders. They do this to avoid paying tax inside a trust. Instead, unit holders are taxed upon receiving the distribution. REITs are required to distribute at least 90% of taxable income annually to shareholders as taxable dividends. In other words, a REIT cannot retain its earnings. REIT shareholders pay taxes on distributions at ordinary rates versus the lower qualified rate. Some of the income from a REIT may be a return of capital, which then allows one to use the lower capital gains tax rate on those returns. It can make sense to hold a REIT in a registered account like a TFSA or an RRSP to ensure tax efficiency and to also avoid some of the challenges in tracking REIT income in a non-registered account. So what are the risks? Although real estate prices have risen, the past does not dictate what will happen in the future. Real estate prices have taken a massive hit before and notably had a big dip in the early 1990s when property prices went very low, taking over 10 years to regain its former price. For people that can afford this dip, it's not a problem, but those who don't have extra cash might be in trouble when time like this come. And at the end of the day, there's no guarantee you'll get a positive return. Liquidity is also an issue for non-traded REITs. This means it's difficult for investors to sell them. Lastly, publicly traded REITs have a risk of losing value as interest rates rise. And lastly, how do you buy it? Canadians can purchase a REIT share the same way they would buy any other stock. You can purchase shares in a REIT mutual fund or REIT ETF. You can also purchase it from a broker. So the key takeaway for this section is that cryptocurrency is a new form of online currency. It is volatile, so you must do further research. Precious metals have unique attributes. They are physical assets and very liquid. And lastly, REITs are an alternative way to start investing in the world of real estate. So we're not done with the presentation. We're just going to review what we've learned today. We covered three important sections and subsections in each one. In the first section, we covered the importance of diversification and the two follow-up strategies which can be used to diversify your portfolio, if you may. Recall that they were asset allocation and dollar cost averaging. On the second section, we discussed the process of buying stocks and the different factors you must take into consideration and further research when purchasing stocks. And in the third and final section, we discussed three alternative options to investments, what they were, how to make money, where to buy, and the risks associated. These alternative investments were cryptocurrency, precious metals, and real estate. So for investment strategies, diversify your portfolio to minimize the risk. Some of the ways to diversify your portfolio based on types of investments, location of investments, and your risk tolerance. And also your asset allocation depends on your goals, age, and risk tolerance. So consider buying different types of assets from different countries and different sectors. Lastly, dollar cost averaging is a great strategy for the long run. Now, how to choose stocks, understand the fees associated with purchasing and selling stocks. There is a lot that goes into choosing a stock, and develop your judgment. You can also reach out to professionals while doing so. Alternative investments that we just finished. Cryptocurrency is a new form of online currency. It's volatile, so you must do further research. Precious metals that have unique attributes. They are physical assets and very liquid. REITs are also a great way to start investing in the world of real estate. So now coming out of this workshop, you should now be much more comfortable managing your investment risks by applying techniques like dollar cost averaging and diversification to your portfolio. You must now also be able to analyze and understand the potential the potential long-term value of a common stock of a company that you choose to invest in and the important metrics to follow. You'll now also know about some alternative investment opportunities to try to diversify and enhance your risk-adjusted returns. So as we discussed, these are some of the key steps of action to evaluating and making investments. This slide details information which we have covered that will help you take action right away. Do your own research. So pick a company where you like their products and try to understand the value of the company and how the stock price has moved around. Ensure you have calculated the relevant ratios, P ratio, DE ratio. Observe the stock's performance, investments, returns, and overall familiarize yourself with the complexities. You should also begin by setting up a practice account at a discount broker. By using a practice account, you can become aware with the fluctuation patterns of investments. You can also talk to financial advisor about investing and, check out more program resources. Be on the lookout for additional program resources which can help you develop better judgment and help increase your investment returns. And also, there are lots of additional resources in the references handout as well. So final tips for this presentation: learn more about risk reduction strategies such as diversification and asset allocation. It also takes time to develop your own judgment. And also, it's important to thoroughly understand the risks associated with each investment type before investing. Okay, so now that brings us to the end of our presentation. Thank you all for listening patiently. So we will now commence with a Q&A portion of the presentation. It's a lot. I know it's a lot of information. So, don't be shy to ask us. And if I can provide assistance, Chad will from CFE will help us out. So any questions, guys? I'll give you guys a couple of minutes. Don't be shy. It's okay. No, it's a lot of information that we covered today.
Yeah, it can be hard because you may have a question that comes up later. Right?
Mm-hmm.
It's that very first step of, okay, well now I've seen the information. How do I even think of a question?
Yes,
So
like how do you
definitely
navigate? Yeah, the information that was brought upon you today.
And
Does anybody have any real experience buying cryptocurrency? Like just in the panelists section? Like I wouldn't even know what the first step is. Like I would imagine that there's like a lot of things that you should be aware of before you think about buying.
Yeah, there's definitely a lot that goes into, especially crypto, because there's so many different levels of it, right? There, even within the crypto market, you're going to get, those Bitcoin and Ethereum that tend to be slower moving, slightly more stable, and then you get the new kind of meme coins that pop up that can skyrocket out of nowhere.
Mm-hmm.
So.
Okay. So there was a question in the chat about a lot of detail, online applications where I can get more information.
Yeah, so there is a resource document that was sent to you in the reminder email and will also be included in the follow-up email that's created by us at CFE. It's got a lot of great resources for you to look further into what we were talking about today. Some kind of reiterating the concepts we looked at, some going a little bit deeper into those concepts, maybe different ways of looking at things to, if it's going to help it click by looking at it in a different area. some of the videos, there's alternative videos you could watch if those will help things make more sense to you. So there's a lot of great information there in that resource document.
Right.
Looks like there's also a question. So for someone who's never invested before, where would be the best place to start?
Well, for me, actually, I did not really start investing until last summer. It it took me graduating university before I started thinking that maybe I should figure out my finances. So I started talking to my group of friends, and we kind of realized we were all on the same page. So we kind of compiled, looked at resources online. We had finance meetings every week because we were all in lockdown. It's pretty fun. So we very looked at Investopedia for some definitions and whatnot. And I think, at least for me specifically, how I started is because I'm still not an expert in investing, but I started with something like Wealth Simple, where they create your own profile, like I mentioned. They diversify your portfolio for you based on your risk tolerance. So I found, for me at least, that was a good way to start, since I'm still not an expert on a lot of these things.
Yeah, that's definitely a great approach, right? It's about identifying your personal risk level. Are you someone who wants to take risk? Are you someone that's going to need the money, and so you're not wanting to take risk?
Yes.
So where do you sit on that? It's kind of a sliding scale. You can be anywhere from absolutely no risk to all of the risk, or anywhere in between. So it's important to figure out where you stand. And then that's going to give you a bit of a direction to look further into things. Looking at programs like Wealth Simple are a great way to start, because you don't want to be doing all of the work yourself and taking on full direct brokerage investing if you don't have the knowledge, or you don't have the time or interest to acquire that knowledge, because there's a lot that goes into choosing stocks. There's a lot that goes into trading on a daily basis, and you need to be prepared to do that research and take that time. And if that's not something that's interesting to you, then it's likely going to pay off better for you in the long run to go an approach where you trust other people to do some of that work for you, because they've done that work themselves.
I also found that it can be very overwhelming for someone who's never invested before to get started. So I did think that that was a good place to start. I also remember that me and my friends, if we found resources that would directly tell us which stocks to invest in, we kind of stayed away from those, because, like we've talked about, like, everyone has different needs and different risk tolerances. So some sources that kind of say, oh, this is the stock to invest in, this is stock not to invest in, we kind of try to stay away from that, because you don't really know which situation you are in, what are your resources, and your risk tolerance. So I think that's also something to keep in mind, if it might help you.
Yep. And if you are interested in getting into direct investing, or even just want to learn a bit more about the stock market, there is a link in the resource document to what we call a paper money account. So that's essentially practice trading. So you're not putting any money on the line. You get to look at how investments would play out and get a bit of a feel for how you actually execute a trade. Because your very first time, if you've got money on the line, that can be stressful all on its own. Is knowing, okay, when I press this button, do I have things set up properly that I know what I'm doing? Or is it going to be doing something I'm not expecting it to be doing? And you're worried about, losing your money. And it's a justifiable concern. And so being in a practice scenario first lets you do those things and lets you feel it out and see what it's going to look like before you actually start putting money on the line.
That's awesome. Okay. So if there aren't any questions, I just would like to share my screen and promote our next one, if I can find it again. Always a challenge with me. Oh, let me just find that. Okay. All right. There we go. So I just want to say that the next Wealthing Wednesday session is join us for the future work in your career, and it's Wednesday, and I can't see that because I'm sharing my screen. And Lindsay's going to put the link to register in the chat. So I think this is going to be very interesting session because as we all know, work has changed dramatically over the last 2 years. So I'm really looking forward to hearing about what the future might hold for us.
Awesome. Well, I think it doesn't look like there are any other questions. So we'll give people a few seconds to grab that link to sign up for the next workshop.
Yep.
And then I will say thank you everybody for joining us. Thank you Mohawk team, Mo Money team for having us here. Thank you Patricia for the presentation.
Yep.
And
Great.
I
Great
hope
job.
everybody has a great rest of your day. And I will see you in a few weeks for the future of work and your career.
All right. Great. Thanks, everyone.
Yeah. Thank you. Bye-bye.
Thank you, everyone. Have